In this video, I'm going to show you how to write off 100% of a new vehicle using the new tax rules that just passed in the big beautiful bill. Bonus depreciation is now 100% as of January 19th of 2025, which means that if you purchase a new or used vehicle after this date, it may qualify for a 100% tax deduction that can save you thousands of dollars in taxes. But you have to understand a few different rules, and I'm going to break these rules down for you in a very simple and easy to understand way as a practicing CPA that tax plans every day at mycpacoach.com. So if you are considering purchasing a new vehicle now or at some point in the future, go ahead and save this video, hit the like button below, and watch this video until the end if you want to learn how to write off 100% of that new vehicle. Okay, so let's start from the very beginning with step number one. You must have a trade or business. The IRS states that if you use your car for business purposes, you may deduct its entire cost of ownership and operation up to certain limits anyway. Now, this does not mean that you need a formal corporation, LLC, or operating agreement, okay? You simply need to earn self-employment income, which is income you can earn as an independent contractor, an unincorporated business, or even through a side gig. For example, someone driving for Uber or Lyft as a 1099 contractor is technically considered to be a self-employed individual in the eyes of the tax law. But the bottom line is that this deduction is reserved for business owners and self-employed individuals. And step number two is that you must purchase a vehicle that weighs more than 6,000 pounds, because when you buy a vehicle that weighs less than 6,000 pounds, the IRS classifies that vehicle as a passenger automobile. And that classification is very important because your deduction is actually limited when you buy a passenger automobile. For example, even with 100% bonus depreciation, the maximum amount you can write off on a passenger automobile is limited to about $20,000 in the first year and even lower limits over the next several years, which means that someone buying a passenger automobile that cost them $60,000 would not be able to write off 100% of that purchase price under their business with bonus depreciation. However, if the vehicle instead weighs more than 6,000 pounds, it is generally not considered a passenger automobile and therefore may be eligible for full expensing with 100% bonus depreciation. So on that same $60,000 vehicle, you could potentially write off the entire $60,000 in the year you purchased that vehicle and placed it into service, which would save someone in the highest tax bracket over $22,000 in taxes that year. Also keep in mind that this is the case even if you finance that vehicle. So let's say you put $10,000 down and finance the remaining $50,000, you may still take 100% depreciation against the full purchase price of that vehicle, which may reduce your taxes while keeping more of your cash in your pockets. Ultimately, if you want to write off the full cost of a new business vehicle, it needs to weigh more than 6,000 pounds. So think about a heavy truck or SUV and not a small sedan or compact vehicle. But simply buying a heavy vehicle is only a piece of the puzzle here. The next piece is in step three. You must use that vehicle more than 50% of the time for business purposes. If you do not actually use the vehicle more than 50% of the time for your business, then it does not qualify for bonus depreciation, which means you cannot deduct 100% of the business use of that vehicle. And in order to use your car for a legitimate business purpose, you need to understand how the IRS defines that. So let's break this down a little bit. So in general, when we talk about using a car for a business purpose, we are talking about using it for business travel, which is defined as traveling from one business location to another business location in very simple terms. Now, that might be travel between multiple offices, work sites, real estate properties, storage units, warehouses, and so on. It might also be travel from your office to other business locations to pick up office supplies, tools, equipment, inventory, or other materials you need to operate your business. It can even be travel to meet with clients, customers, vendors, or even your own employees and business partners at places like restaurants, conference rooms, or other business venues. But as you can probably imagine, this will look different for every profession. A landscaper might write off their landscaping truck to travel to their customers, and a real estate agent might write off their vehicle to travel to different properties. But the big picture here is that you need a legitimate business purpose for your vehicle to write off any portion of it. And if you're talking about using 100% bonus depreciation, that vehicle must be used more than 50% of the time for those business purposes. If you are questioned by the IRS about this deduction, you may need to substantiate or prove how you are using that vehicle for your business. So to protect yourself, it is generally recommended to keep a mileage log and document when and how you are using that vehicle for your business and how that business use percentage is being calculated. I will include some applications that I personally use to help me with this in the description of this video, but documentation is extremely important if you want to avoid issues down the line with this. Also, please keep in mind that 100% bonus depreciation is only applied to the business use portion of your vehicle. For example, if you buy a $60,000 vehicle and use it 100% of the time for your business, you can write off 100% of that vehicle. But if you only use that vehicle 50% of the time for your business, then your deduction will be limited to 50% of that vehicle, or $30,000 in this example. But even with that said, there are two more big steps you need to know to get this right. So let's move on and discuss step number 4, choosing the best vehicle deduction method. So on the highest level, there are two ways to deduct your vehicle. There's the standard mileage method and the actual expense method. And 100% bonus depreciation is only possible with the actual expense method. So let's make sure you understand this. So with the standard mileage method, your vehicle deduction is simply based on the number of business miles you drive for your business. For example, in 2025, the tax law grants you a 70 cents deduction for every mile you drive for your business. So if you drove 10,000 business miles, you would have a $7,000 vehicle tax deduction, and that's it. You would not be able to take bonus depreciation if you elected to take the standard mileage deduction. And to that point, if you take bonus depreciation in the first year, you cannot turn around and take the mileage deduction in future tax years either. So if you are someone who accumulates a lot of business miles, you should carefully consider the potential impact of losing your standard mileage deduction if you plan to use bonus depreciation. Now let's turn our attention to the actual expense method, which does allow you to use 100% bonus depreciation. So with this method, you are able to write off your actual car expenses, like your gas, oil, repairs, insurance, license fees, registration fees, and depreciation, like I just mentioned. So let's say we bought a $60,000 vehicle that weighs over 6,000 pounds, use it 100% of the time for our business, and also have $10,000 of other car expenses. Well, in that case, we will be able to take a $60,000 depreciation deduction with 100% bonus, plus write off $10,000 of our other actual car expenses, granting us $70,000 in tax deductions. That's how powerful bonus depreciation is. But there is a big caveat to consider in step number 5, which is planning for depreciation recapture. So I'll be honest with you, depreciating 100% of a vehicle is great until you sell the vehicle, stop using the vehicle in your business, or dispose of it altogether. Because once you depreciate 100% of that vehicle, your basis in that vehicle is now zero, which means that if you turn around and sell that vehicle for, let's say, $30,000, then that $30,000 will be taxable to you at ordinary income tax rates up to 37%. In the tax world, this is referred to as depreciation recapture. Because we are getting an ordinary income tax deduction when we claim depreciation, we also have to report any gain on selling that property at a later date as ordinary income to the extent of the depreciation we took. And you are required to recapture depreciation on vehicles when either A, you sell the vehicle, B, you dispose of that vehicle, or C, the business usage of that vehicle drops below 50%. So even if you keep the vehicle, if the business usage of that vehicle drops below the acceptable threshold of 50%, you may have to recapture the depreciation that you've claimed. Now, how the recapture is calculated varies depending on the scenario. If you are selling the vehicle, the recapture is only up to the sales price. Whereas if you're disposing the vehicle, or you're in a situation where your business usage of that vehicle is not high enough, you would have to factor in other IRS rules here. So to protect yourself, it is highly recommended to get a CPA involved to help you best navigate all of the different rules at play here. And ideally, if you are planning on buying a business vehicle, you also have a tax plan that helps you save the most amount of money in taxes along the way. And if you don't have that and you want a plan that is guaranteed to reduce your taxes, just apply to work with my team today at mycpacoach.com.